Most traders spend years working on themselves. They journal, they meditate, they examine their emotional patterns. They read books on discipline, consistency, and the mental side of trading. And they still lose. Not because the inner work does not matter, but because they skip the most important question that should be asked first, or they assume they have already answered it. Does your strategy actually work? Not does it feel like it works, not did it work last Tuesday, not does it make sense on paper. Did it work over hundreds of trades, even thousands of trades, across different market conditions, in years of data, with numbers that actually prove it? Do you actually have data? If I asked you right now what your strategy's win rate has been over the last 5 years, could you answer? Or did you backtest 2 or 3 months and assume your strategy is profitable? To be blunt, most traders do not know their strategy's data over the last 5 years. They skip doing this. I was part of this too, until I realized this is not optional. It is mandatory. Because here is the painful truth most traders never face. You can have perfect psychology on a broken strategy, and you will lose perfectly, consistently, disciplined, while your bank account melts. And as a result of losing, you can blame your psychology, when in fact you do not have enough data, and maybe your psychology is not to blame. The problem might be insufficient data. Meet Ryan. In his third year of trading, Ryan had done everything right on the mental side. He had a journaling habit. He never revenge traded. He followed his rules with impressive consistency. Drawdowns were controlled, emotions balanced. But his account was slowly bleeding. Month by month, small losses that never turned into profit. He thought he needed more discipline, more patience, more psychological work. So he kept working on the inner game. When in fact his trading strategy was far weaker than he thought. He thought he had a profitable strategy because his first few months closed profitable. And because of this, he assumed his strategy was profitable and continued. When in fact his strategy was not as profitable as he thought, and maybe if he did a 5-year backtest it might not even come out profitable. But he did not have that data. He assumed it was profitable because his strategy worked well for 1 month and continued. And this is why when problems arose he blamed his psychology, not his strategy. And yes, most people's problem is psychology, not strategy. But that does not change the fact that for some, the problem is the strategy. So you must be certain about the strategy part. This is not up for debate. What Ryan never did and skipped was this: sit down and prove his strategy actually works. He had done a loose backtest over 60 or 70 trades in a few months. It looked promising. The logic was sound. He believed in it, and that belief built a wall between him and reality. He did incomplete work, and because of this, he looked for the problem in the wrong place for months. More journaling, more meditation, better psychology. He thought it would solve everything. But it did not, because he did not know if his strategy was actually profitable. I made this mistake myself. I had 6 months of data, and my strategy looked good. I thought I was sure it was profitable, and I stayed loyal to my strategy for a long time. And still, something went wrong. And mostly I looked for the problem in the wrong place because I had already assumed my strategy was profitable. So I had to look for the problem elsewhere. But when I did the work I was supposed to do, when I did a 5-year backtest, I saw that my strategy was not as profitable as I thought. And then I came to the conclusion that my win rate needed to increase, and I started working in this direction, because it was not as profitable as I thought. But because I did not know this, I looked for the problem elsewhere. This is a common mistake, and please do not do this. Whatever your pair is and whatever your strategy is, have at least 5 years of data. You can do this in a few weeks by setting aside 3 to 4 hours on weekends. It is not that hard. After you do this, you will see whether it is really your strategy that is the problem or your execution, meaning your psychology. And here is the truth Ryan had to face. His strategy's expected value was actually negative. A few profitable months did not actually mean his strategy was profitable. Maybe it was not dramatically negative. Not negative enough to blow the account, just the kind of strategy that quietly, persistently loses over large sample sizes. And no psychological work could fix this. But because he avoided doing the work, meaning backtesting and gathering data, he could not see this and therefore tried to accomplish the impossible. On the other hand, Casey had a different problem. She knew her strategy worked because she had tested it properly. 5 years of historical data, and she knew it was profitable. Over 400 trade samples. Different market conditions, trending markets, ranging markets, volatile and calm periods. The numbers showed a clear edge. Not a perfect edge, not the holy grail, but a real, proven, repeatable edge. And this was enough for her to be profitable and make the money she wanted. But there was another problem. Her psychology was terrible. She overtraded. She moved stops. She got emotional after losses. The execution part was truly almost terrible. But the difference between her and Ryan was this. She had something she could trust. When things got hard, she could go back to the data. She could say, "This strategy works. I proved it. The problem is in my execution." She could say this clearly, unlike Ryan. That certainty provided a foundation she could build on, a solid foundation. And she was sure what the problem was, unlike Ryan. She fixed her psychology in 8 months because she was fixing execution on a strategy that actually had an edge. And she had not skipped the real work, meaning the data. She had enough data, and every weekend she spent 2 hours on backtesting for more data. Casey understood something most traders miss. Data is not just about proving your strategy works. It is about knowing exactly what you are working with. She knew her strategy's win rate varied between 41 and 47% depending on volatility. She knew her average winner was 1.4 times her average loser. She knew she needed roughly 60 trades per quarter to see her edge materialize. She knew all this because she did the work. So when she had a losing week, she did not panic. She checked, "Am I still following the rules?" Yes. Then it is just variance. When she had 3 losing weeks in a row, she did not question the strategy. She went to her data, checked the longest historical losing streak. It was 4 weeks. She was at 3. Still within normal range. This is what data gives you, not just proof that it works, but a map of what normal looks like. Without that map, every loss feels like failure. With it, losses become navigation points. You know where you are. You know it is temporary. You keep executing. Ryan spent 3 years fixing psychology on top of nothing. Casey spent 8 months fixing psychology on top of proof. And Casey had succeeded in fixing her psychology and reached the point where she could get the profits her system promised. Ryan, on the other hand, did not have to return to backtesting after 3 years of working on psychology in vain. At least he realized the problem, even if late. The difference was not discipline. It was not talent. It was sequence. Here is what nobody tells you about the psychology-first approach. Everyone says this assuming your strategy is already solid. But really, how many people have a strategy with 10 years of proven data? Or do most people backtest a few months and assume their strategy is profitable? Let's not fool ourselves. Most people consider a few months of backtesting sufficient and say, "I have a profitable strategy," and continue. All that advice about controlling your emotions, all those frameworks about process over outcome, all those lessons about staying disciplined through drawdowns, all of these are things told to you assuming you are working with a strategy that has a real edge. It assumes you have a real foundation. Without this foundation, you are not building discipline. You are building the skill of losing inconsistently. So the first thing you need to do is have at least 5 years of data for your strategy and be sure it works enough in your favor. Even if your strategy is profitable, it may not be as profitable as you think. And if you do not know this, you may assume there is another problem, because your strategy is not making you as profitable as you want. When in fact, maybe your win rate is not 45 to 50%, but somewhere between 35 to 40%. You happen to encounter it where it was 45 to 50%, and then when you trade at a time closer to its actual value, you may think something is wrong. Even if your strategy is profitable, it may not be profitable enough to satisfy you and you may need to improve it. But to have an idea about all of this, you must have data. Having data is the first step in this work, and this is not a step you can skip. You must do this. This is part of your job. Go and extract your strategy's data. If you have come this far, assuming you have a profitable strategy, go and turn this assumption into a guarantee. Then you think about the rest. First, be sure you actually have a profitable strategy, and see what it promises you on a monthly and yearly basis. Maybe afterward you will think that strategy is not enough even if it is profitable, and as a result, you will look for ways to take this win rate higher, and this will change everything for you. You do not have the luxury of skipping this step. Extract your data as soon as possible. So how do we know if your strategy actually works? I want to talk about this a bit too. The first and most important issue is sample size. This is exactly what misleads most traders. You do not know which era of your strategy you are encountering, and it is impossible for you to know. Most traders test a strategy for 2 or 3 months, take 30 or 40 trades, and make a decision. But 30 trades say almost nothing. Variance in trading is massive. A bad strategy can look profitable in 30 trades. A great strategy can look terrible. You need at least 200 trades to start seeing something real, 500 trades to say something with real confidence. Anything below this is coin flipping disguised as fundamental analysis. At least 500 trades or 5 years of data. My personal recommendation is definitely backtest the last 10 years of the pair you trade. The data you can trust most is the last 10 years of data. If you have a strategy in the last 10 years that is truly consistent and profitable enough to satisfy you, congratulations. Now, if things really do not go right, you can blame your psychology. The second issue is market conditions. Market conditions are variable. Markets are cyclical. They trend. They move sideways. They become volatile, then calm down. A strategy that works great in a trending market can destroy you in a choppy market. If you tested your strategy in one specific market environment and then traded in a completely different environment, your results will deviate from expectations. Not because your psychology failed, because your sample was not representative. This is exactly why you must test for a long time. This is where 5 years of data becomes important. Not because 5 years is a magic number, but because it provides enough variety to see how your strategy performs in different conditions. Bull markets, bear markets, high volatility regimes, slow choppy sideways movements. If your edge holds across this variety, you have something real. If it only works in one type of market, you have something fragile. You must be sure you have a real edge. You cannot leave your work to chance. Maybe your psychology is good enough and your strategy is to blame. You must know the answer to this question. The third issue is how we interpret results. People are incredibly good at seeing patterns that confirm what they want to believe. You take 10 trades, 7 win. You think you have a 60% win rate, but those 10 trades happened in a trending week where almost anything would work and it misleads you. The brain does not weight this context. It just sees 7 wins and feels justified, feels invincible, assumes it figured it out. This is why emotional attachment before proving a strategy is dangerous. The more you want it to work, the more evidence you will find that it works, even if the real numbers tell a different story. You see the proof and ignore what says otherwise. So before you emotionally bond with your strategy, make sure it is worth it. Meaning, make sure it is profitable enough. Meet Jordan. Jordan had been trading the same breakout setup for 14 months. Results were inconsistent but not terrible. Some months profit, some months loss, roughly flat. He told himself this was a psychology problem. He could not pull the trigger consistently. He doubted entries. He needed more discipline. So he spent 6 months working on mindset. His execution improved noticeably. He was more consistent than ever. And his results got slightly worse. When Jordan finally sat down and did a proper backtest, the real picture emerged. His strategy had a 44% win rate, average winner barely bigger than average loser, flat or slightly negative expectancy in 3 years of data. The market had changed since he first developed the setup and the edge had quietly eroded. For 2 years, he had been psychologically optimizing a car with no engine, and he was trying to accomplish the impossible but was unaware of this. And the worst part, Ryan genuinely believed he was doing the right thing. Every trading book told him psychology is everything. Every guru preached mindset over method. Control your emotions. Master your mind. The strategy does not matter if you cannot execute. All true, but incomplete. Because they assume you already have a working strategy. They assume the foundation exists. Ryan skipped checking if the foundation was real. He built a mansion on sand. Spent 3 years decorating rooms in a house that was sinking. And he never knew. Because he never verified the ground beneath him was solid. He trusted. He believed. He assumed. And assumption in trading is expensive. The market does not care about your belief. It does not reward faith. It rewards reality. And reality requires proof, not hope, not theory, not a few good months. Proof. Verifiable, repeatable, data-backed proof. Ryan did not have it. So he paid for it. In time, in capital, in psychological damage from blaming himself for a problem that was never his to fix. And he kept blaming himself and his psychology in vain, when in fact he fell into this state because of the work he skipped doing. He was too lazy to backtest and thought a few months of data was sufficient. But it was not. The hard part of Jordan's story is not the discovery. It is the previous 2 years. 2 years spent genuinely working on mental control, developing as a trader, built on a foundation that would not hold. None of this work was wasted in terms of personal development, but as a path to profitability, it was circular. He was solving the wrong problem, and he failed only because of this. Now here is where things get more complex. The opposite mistake is equally dangerous. Some traders use the logic of "I need more data" to avoid trading. They backtest forever. They use backtesting as escape. They are afraid to trade in real market conditions and fail, so they optimize endlessly. They need one more year of data, one more market condition, one more confirmation before they commit. This is analysis paralysis wearing a rational disguise, and it is as costly as trading a broken strategy, because the other way to prove edge is live application. Backtesting shows what worked historically. Live trading shows whether you can actually execute it. So do not go crazy with backtesting. Of course, that is not what I mean. Do enough backtesting and get to live trading as soon as possible. The goal is not perfection. The goal is honest assessment. You need enough data to know if you are working with something real before doing years of psychology work. This is at least 500 trades or 5 years of data. Multiple market conditions. Honest numbers you did not unconsciously cherry-pick. If you have this, your psychology work has a foundation. If not, you are building in the air. Answer this question honestly. Have you proven your strategy actually works? Not that you believe it works, not that it looks logical. Have you run it on enough data, enough trades, enough market conditions to say with near certainty that your edge is real? If the answer is no, that is where you start. Not psychology. Data. Build the sample size. Backtest properly. Use at least 2 to 3 years of historical data, preferably 5. Run it in different market environments. Calculate your real win rate, real average winner and loser ratio, real expectancy. Get honest numbers. This way you are sure of what you are dealing with and you manage to stay calm comfortably knowing you will be profitable even if things go wrong. You cannot do this with 2 months of data. Doubts will arise. But if you have 5 years or even 10 years of data, you trust. And even if things go wrong, you know it will turn in your favor after a while, because you proved it and saw it. If the numbers show a real edge, your psychology work has a target. You are not fixing yourself abstractly. You are closing the gap between what your strategy can produce and what your execution is currently producing. This gap is real, measurable, and something you can actually work on. If the numbers do not show an edge, you have saved yourself from spending years of psychology. Work on a foundation that will never hold. The traders who reach success are not necessarily the most disciplined. They are not always the ones with the most emotional control either. But they share one thing. At some point, they stopped guessing and started knowing. They did what was necessary to prove their edge was real before dedicating years to it. Psychology matters. It matters tremendously. But psychology is the second step, not the first. Data first. Everything else after. Please handle this work as soon as possible. Have the data. Then you start thinking about psychology. There are already plenty of videos you can find for that, but there is no video that will tell you the results of your own data. So extracting that data is part of this work, and you must do it. If you do not know whether your strategy works, this is not a mindset problem. This is a homework problem. Do the homework, because nothing is more expensive than perfect discipline applied to the wrong strategy.